Well, there's no question that the inflation we saw over the summer was heavily driven, almost three-quarters, by things like used cars, new cars, rental cars, return to normal in travel, and the like. What you're seeing today in the headline numbers, of course, is a lot on food and energy, some of that being driven by supply chain. I think we're actually in the part of the process now on the core inflation numbers where you're actually seeing some step back. You'll see airline prices come back down as Delta came up. You're seeing some of the car prices come down. And that's covering up, I think, some increase and some broadening of the inflation numbers, to other areas. So I do think there's risk on the inflation side, and I'm watching that very carefully.
Is it your sense that inflation is going to come down next year? And what kind of numbers are you looking for?
Well, I think the supply chain pressures are going to stay elevated for a lot longer than I would like. I just think American firms are having trouble getting materials, getting parts, getting labor, and getting goods to market. So we're going to see those extend. As I said, some of these prices, used car prices are not going to stay high forever. Rental car prices are not going to stay high forever. So there'll be some reversion here. But I think we are going to see a more extended time period on these supply chain pressures.
The minutes came out this week and said that there's a possibility of a mid-November or a mid-December beginning for the taper. Do you favor either of those particularly or neither?
Well, if we do decide to taper at the next meeting, we're going to have a discussion on which of those two dates, I'm sure. And my instinct would be, if you're going to decide it, go ahead and move. But I'm certainly going to be open to the debate on both sides.
I need to press you on that. Is it say you're not decided yet about whether or not the Federal Reserve should begin to taper its asset purchases?
Well, we're going to have a discussion in November on tapering, as I'm sure. And I do think we've come a long way on both the labor market and certainly on inflation against our goals since December. So I'm supportive of beginning the process of normalization. I think the question you asked was November, December in terms of the date to start. And that's, I think, going to be a good, I'll learn something in that discussion.
In the last several weeks, President Barkin, the Fed funds futures market has begun to price in a rate hike as soon as September. And it had been the first one in December. Where do you stand on that? Is there a possibility that sometime in the summer the Fed can and should be raising interest rates?
Well, when we start tapering, that'll give us some amount of time to test what I think are two core questions that I just don't know the answer to, and we'll learn a lot in the next several months. One is on inflation. Will inflation come back to the levels of the last 25 years, or inflation going to hover somewhat closer to the level of the last 6 months? That's this question of inflation expectations and what's really going to drive them going forward. We'll learn a lot about that per your last question. The second thing we'll learn a lot of is how close are we to maximum in the labor market? There's still 5 million people not working who were working in February 2020. I'd certainly expected more of them to come back in the fall with the virus presumably down and schools reopen and enhanced unemployment insurance expired. We haven't yet seen that, but maybe we will see it. So is the labor market going to be this tight over the next 6 months? Is inflation going to come down or not? And different answers to those questions, in my mind, would lead me to have different points of view on when we would start to increase rates.
I'm curious why you wouldn't answer it a different way, that same question, which is the Fed provided a bunch of emergency relief to the economy from the pandemic. And the appearance is that the economy has, in many ways, from a GDP standpoint, come back at or above where it was before. Why wouldn't you just remove the emergency stimulus you provided because it's not needed anymore?
Well, as you know, a lot of these emergency facilities have wound down and been, put back in the tool shed. We're talking next, I think it's just a defined sequence to this. So we're talking next about asset purchases and the question of how to scale those back. And then I think after that would come rates.